Alan, let me start with you. What do you think ails Netflix most of all, and what do the next 2 or 3 years look like for this stock and this company? Is it just an ordinary stock now?
Thank you, Tyler. I think the thing that ails them the most is saturation in the U.S. market, the largest market. You know, with password sharing, they're probably close to 85–90% of the market right now. Where's the stock going from here? I think the event path is going to be pretty tough for the next year or two until they roll out charges for password sharing and advertising. The second quarter is going to be this down 2 million sub quarter. Third quarter, they're going to have the comp against Squid Game, their biggest product ever. And they're going to also go against Amazon's release of Lord of the Rings, the most expensive series ever. So you've got tough competition, and they've got to basically edit the model to add in advertising and add in password sharing.
Julia, let me turn to you and ask what the buzz is out in Hollywood and in the entertainment business about what happened to Netflix. Are people yapping about it? Are people saying, hey, wait, we got to rethink the whole streaming business in light of this? What's the buzz?
Well, there is a lot of yapping about it, as you put it, Tyler. But I also think this identification of the fact that Netflix has always done things its own way. They didn't worry for many years about cracking down on password sharing. Now they're shifting their perspective. They were anti-advertising. Now they're talking about trying to get an ad-supported model up and going in the next year or two. And so I think this realization that you have to really generate revenue from all of your viewers is something that the more traditional media companies that have gotten into streaming have been pushing for a long time. And it makes these companies such as NBC Universal with Peacock or HBO Max with an ad-supported version or Paramount with an ad-supported version of Paramount Plus look smart in that they were thinking about multiple price points for different types of consumers and trying to make sure that they could keep their prices down with ads. So I think there's also this sense that Netflix is going to have to make not just a massive quantity of content, but really focus on quality. And this is something that co-CEO Ted Sarandos also mentioned in that earnings call yesterday.
Alan, why do you think their guidance was so bad? Look at this way. They obviously know why. But why have they decelerated so quickly and to such an extent?
Yeah, well, Kelly, first of all, the second quarter is always weaker than the first quarter. So I was surprised that the second quarter expectations were for a flattish amount versus the first quarter, without the Russia impact. But down 2 million, that's a very negative amount. Also, but keep in mind, Netflix has 220 million subs. Every 0.25% of churn equals about 1.7 million subs. So churn ticks up just slightly. And that's the difference from roughly having break-even subs and being down 1.7 million. I think the biggest issue, though, is competition right now.
Yeah, and Ed, to that point, the rest of the streaming complex is selling off today. And as Lauren Martin said last hour, she thinks that's a sign that consolidation may actually get sped up here. Obviously, we can't have this many standalone players. Where do we go from here?
So again, I think the issue of password sharing it's not real issue, right? Because that's been happening since the beginning of Netflix. I think, competition, as Alan pointed out, is the real bugaboo here. And, does that mean, if most households are paying for about 3 or 4 services, is that really it? It can only have that much with some smaller players or sort of single interest players sort of in the smaller route. I think so. I think that's where it's going to head. I think Netflix, to get its supercharged growth back, whatever it needs, whether it's gaming or other things or even theme parks, they have a lot of IP, if you want to look at it in those terms, would be capital intensive. So at their current trajectory, growth is not going to be the same. If 300 million is the top line for them, they'll get there. It'll just take that much longer. And that's what investors are responding to. It's just they're looking at the multiples thinking like, well, we used to trade this at 60, 100 times forward earnings. Now it's 30 times. I think that's where it's going to sort of level out. It's going to be like that's the new Netflix going forward, unless they do something big. Consolidation could be it, yeah.